What if I told you there's an ETF that turned $10,000 into $85,000 in just 10 years? And no, I'm not talking about some sketchy penny stock or crypto gamble. I'm talking about a legitimate Fidelity ETF that you can buy right now in your brokerage account. Sound too good to be true? Stick with me because I'm about to show you the math. Look, VOO is solid. It's the S&P 500. It's safe, it's cheap, and millions of investors trust it. But here's what nobody tells you. While you're earning respectable returns with VOO, there are 3 Fidelity ETFs that have been quietly destroying its performance. I'm talking about one ETF that delivered a 751% return over the last decade, another that pays you 3% dividends while still growing 15.8% annually, and a third that barely flinched during the brutal 2022 crash. The crazy part? You can combine all 3 into one killer portfolio, no matter your age. Today, I'm breaking down the exact numbers, showing you real dollar amounts, and giving you age-specific strategies so you know exactly what to do whether you're 25, 45, or 65. Ready? Let's dive in. ETF number 1, the growth monster, the big reveal. First up, we have FTEC, the Fidelity MSCI Information Technology Index ETF. And when I say this thing has been crushing it, I mean crushing it. The numbers that'll blow your mind. Check this out. Over the last 10 years, FTEC delivered a 22.35% annualized return. Let me put that in perspective. While VOO was doing a solid 14% annually, which is great, don't get me wrong, FTEC was nearly doubling that performance. So what does that actually mean for your wallet? The real dollar impact. Remember that $10,000 I mentioned? If you had invested that in FTEC 10 years ago, you'd be sitting on roughly $85,000 today. That's not a hypothetical. That's real money. Your initial investment grew more than 7 times in a single decade. That's a 751% total return. And here's the kicker. You paid almost nothing for this performance. The expense ratio is just 0.08%. That's $8 per year for every $10,000 you invest. Basically pocket change. What are you actually buying? So what's inside this beast? FTEC tracks the technology sector. You're getting exposure to over 300 tech companies, Apple, Microsoft, NVIDIA, and all the players building the future. We're talking AI, cloud computing, semiconductors, all the stuff that's actually driving the economy forward. The reality check. Now, I'm not going to sugarcoat this. Is tech volatile? Absolutely. When the market crashes, tech stocks usually get hit harder than everything else. But here's the thing. If you're young and you've got decades ahead of you, that volatility is actually your friend. It's what creates those massive long-term gains. This is your growth engine. This is how you build wealth.
But what if you want to get paid while your money grows? What if you want cash hitting your account every 3 months while your portfolio still appreciates? That brings us to number 2. ETF number 2, the income machine. Enter FDV, the Fidelity High Dividend ETF. This is the fund that most growth-obsessed investors completely sleep on. And honestly, that's their loss. The double threat. Here's what makes FDV special. It pays you a 3.02% dividend yield. So on a $10,000 investment, you're collecting about $300 per year in cold hard cash, paid out every single quarter. But wait, it gets better. The growth story. This isn't some boring, slow-moving dividend fund that barely keeps up with inflation. Over the past 5 years, FDV has delivered a 15.8% annualized return. Do the math with me. A $10,000 investment 5 years ago would be worth approximately $20,480 today. Your money doubled in 5 years. Plus, you collected quarterly dividend checks the entire time. The cost? And what are you paying for this 2-for-1 deal? Just 0.15% in fees. That's $15 per year on a $10,000 investment. Totally reasonable. What's inside? FDV focuses on large and mid-cap companies that pay high dividends and have a history of growing those dividends consistently. These are established, profitable companies that actually share their earnings with you. Who this is perfect for? If you're in your 40s or 50s and starting to think about generating income without selling shares, FDV is an absolute game changer. You get growth, you get income, you get quarterly cash flow that you can either reinvest or spend however you want. It's the perfect middle ground. Now, growth is great, income is awesome, but what about when everything goes sideways? What about when the market crashes and everyone's panicking? That's where our third ETF comes in. ETF number 3, the recession shield, the defensive play. Meet FHLC, the Fidelity MSCI Healthcare Index ETF. This is your insurance policy. This is what helps you sleep at night when the markets swing crazy. The steady Eddy performance. Since its inception in 2013, FHLC has delivered an average annual return of 10.94%. Now, I know what you're thinking. That's not as exciting as 22%. You're right, but check this out. The 2022 crash test. During the brutal 2022 bear market, when the S&P 500 dropped 18% and tech stocks got absolutely demolished, how much did FHLC fall? Just 5.88%. Let that sink in. While everyone else was watching their portfolios crater, healthcare investors barely felt a bump. The dollar math. A $10,000 investment held since 2013 would be worth approximately $38,120 today. Not explosive, but consistent and reliable. Why healthcare is different? Here's the secret. People don't stop needing medicine when the economy tanks. They still go to the doctor. Hospitals don't shut down during recessions. Healthcare is what we call a defensive sector. It's recession resistant. What you're getting? FHLC holds over 334 healthcare stocks across pharmaceuticals, biotech, medical devices, and healthcare providers. You're getting diversified exposure to the entire industry. And you're paying just 0.08% in fees. That's $8 per year on a $10,000 investment. Who needs this? This ETF is perfect if you're closer to retirement or you just want to protect your wealth when everything else is falling apart. It's not going to make you rich overnight, but it's going to keep you rich when the market's trying to take everything away.
The power of combination. The synergy. Now here's where it gets really exciting. You don't have to pick just one of these. In fact, you shouldn't pick just one. These three ETFs are designed to work together like a well-oiled machine. FTEC gives you explosive growth. FDV gives you income and steady appreciation. FHLC gives you stability and protection. This is how you build a complete portfolio that performs in bull markets, bear markets, and everything in between. But the big question is the allocation strategy, the setup. How do you actually use these three ETFs? How much of each should you own? The answer depends on one thing, your age. Let me break it down for every stage of your investing journey. Ages 20 to 35, the growth maximizer. Suggested split, 70% FTEC, 20% FHLC, 10% FDV. You're young. You've got time on your side. Your portfolio can handle volatility. So we're going heavy on tech with 70% in FTEC. That's your wealth building engine. Add 20% FHLC for some defensive protection. You still want to survive the crashes. And throw in 10% FDV just to get a taste of dividend income and understand how it works. This allocation is all about maximizing long-term growth while you've got decades to compound. Ages 35 to 50, the balanced approach. Suggested split, 50% FTEC, 30% FDV, 20% FHLC. You're in the sweet spot. Still young enough for aggressive growth, but mature enough to start thinking about income and stability. 50% in FTEC keeps you capturing those tech gains. But now we're bumping FDV up to 30% because those quarterly dividend checks are starting to feel really nice. And 20% FHLC gives you solid downside protection. You're building a portfolio that can handle whatever the market throws at you. Ages 50 to 60, the income shift. Suggested split, 30% FTEC, 40% FDV, 30% FHLC. Retirement is on the horizon. Income and stability become the priority. You're still keeping 30% in FTEC because you don't want to miss out on growth entirely. But now FDV takes the lead at 40%. Those dividends are doing the heavy lifting. And FHLC at 30% gives you serious recession protection. Your portfolio can handle market volatility without derailing your retirement plans. Ages 60 plus, the preservation mode. Suggested split, 20% FTEC, 50% FDV, 30% FHLC. You're in or approaching retirement. Preservation and income are everything. 50% in FDV means you're generating strong, consistent dividend income. 30% in FHLC keeps you heavily defensive. And 20% in FTEC, that's just enough tech exposure to benefit from long-term growth without taking excessive risk. This is the sleep well at night portfolio.
Now, I want to be crystal clear about something. These aren't rigid rules carved in stone. They're a framework. Adjust based on your personal situation, your risk tolerance, and your financial goals. Maybe you're 55, but you've got a massive emergency fund and a high risk tolerance. You might want more tech. Or maybe you're 30, but you sleep better with more stability. You might want more healthcare. Use these as a starting point and customize from there. Disclaimer, and speaking of personal situations, I need to say this clearly. I'm not a financial advisor, and this is not financial advice. Do your own research, talk to a professional if you need to. Make sure any investment decision fits your specific situation. This is educational content, not a recommendation to buy or sell anything. So there you have it. 3 Fidelity ETFs that most investors have never even heard of. FTEC for explosive growth, FDV for income and appreciation, FHLC for recession protection. Combined together, they create a portfolio that can handle anything the market throws at you. If you found this breakdown valuable, smash that like button and subscribe for more investing strategies that go beyond the basics. Drop a comment below and let me know which of these 3 ETFs you're most interested in, or if you're already using any of them. Thanks for watching, and I'll see you in the next one.